let us prepare accounting equation for the following transactions. The first transaction is started business with cash 3,50,000 and stock 50,000. Now students, here the owner has brought in cash worth rupees 350 and stock worth rupees 50,000. That means he is bringing a total capital of rupees 4 lakh into the business, 350 in the form of cash and 50,000 in the form of stock. Then the second transaction is a simple transaction, purchase goods on credit rupees 50,000. The third transaction is sold goods costing rupees 50,000 for rupees 60,000. Now as this transaction makes it clear, goods costing rupees 50,000 have been sold for 60,000. That means there is a profit of rupees 10,000 which must be shown for in the balance sheet or in the accounting equation. Then the last transaction is paid to creditors rupees 20,000 on account. Now students, 20,000 on account. Let us understand what payment on account means. By payment on account we understand that 20,000 have been paid now and remaining amount or the balance amount, if any, would be paid off at a later date. It does not mean that the remaining amount is discount or would not have to be paid. It means clearly that the remaining amount, whatever it is, would be paid off at a later date. So now let us come to the practical aspect of it. The first transaction is that the owner has brought in cash and stock. Now from the point of view of business, we are getting a cash of rupees 3,50,000. Cash is an asset. So let us create a column of cash and add 3,50,000 rupees. Owner is also bringing in stock. Stock is an asset. So under the column of assets, we'll create a sub column of stock and add 50,000 rupees to it. The total is 4 lakh rupees and this sum has been brought in by the owner. So owner's account is represented by capital. So add 4 lakh rupees to the capital. External liabilities are not there. So we can see that the total is 4 lakh on both the sides. Coming to the second transaction, purchase goods on credit. Now since we have purchased goods on credit, that means the business is getting goods worth rupees 50,000. Goods are our assets and they should be added to the stock. So the first effect is add the value of goods that we have purchased to stock. The second effect is that we have purchased them on credit. That means we now have a liability of rupees 50,000. Since we have purchased them on credit, we have not yet paid. Since we have not yet paid, it would be our liability and it should be written under the column of creditors. Let us total these two transactions and find out whether they are equal or not. So the new equation becomes 3,50,000 in cash, 1 lakh in stock, the capital is 4 lakh and the creditors are 50,000. It is very clear that we have total assets of 4,50,000 and capital and liabilities also equal to 4,50,000. Now students, the third transaction, sold goods costing 50,000 for 60,000. That means goods to the extent of rupees 50,000 have been sold by the business. Since they have been sold, let us reduce the value of stock by rupees 50,000 and what we have received rupees 60,000. So this 60,000 would be added to the value of cash since we are receiving in cash. Now in this transaction, an asset for rupees 50,000 was sold off for rupees 60,000. So there is a corresponding profit of 10,000 and profit would be added to capital. So now the new equation becomes 4,10,000 worth of cash, stock worth rupees 50,000, capital worth rupees 4,10,000 and liabilities of rupees 50,000. Now the last transaction, paid to creditor. Paid to creditor means that payment has been made, and obviously payment would be made in cash. So we will deduct 20,000 rupees from cash. Since we have made the payment, so deduct 20,000 rupees from cash. Now this payment has been made to creditors. Since this payment has been made to creditors, that means our liabilities would be reduced by rupees 20,000 rupees. So deduct 20,000 rupees from the liability column as well. And let us verify that they are equal. The new equation now becomes, we have cash of rupees 3,90,000 and stock of rupees 50,000. Our capital is worth rupees 4,10,000 and liabilities are there for rupees 30,000. It can be easily verified that the total on both the sides is 4,40,000.